Welcome back to Vantage. We are kicking off season 4. There's quite a lot of volatility in the market, and the debate as to have valuations run too far, or are we going to be okay? As people are looking for a margin of safety, I thought it'd be great to get a global income manager in. Let's go take a look. Welcome back to Vantage, kicking off a new season, and it's a time where quite a lot of investors are thinking about margin of safety. So we thought it'd be great to get an income provider onto the show. We are delighted to have Martin Connaghan from MYI International here. For viewers less familiar with MYI International, maybe just run through what it offers investors and how it differentiates itself from its peers.
Sure, thanks for having me, first of all.
Pleasure.
MYI International is a large global equity income trust. It's got assets of about 2 billion sterling at the moment.
Yeah.
And we're trying to deliver an above average dividend yield, which is around 4.5%, so above the average of our peers within that classification. And I guess the one thing that makes us sort of different from our peers is that we're trying to earn the income. We're trying to cover the dividend from the underlying revenues that we receive from the businesses. So that leads to slightly different outcomes in terms of style. It's probably slightly more defensive in nature. It's certainly more value in sort of nature in terms of style. So yeah, a large global equity income trust that tries to cover its dividend and pay shareholders for 4.5% and grow that dividend and the capital over the long term.
Yeah, and it is global. So when I was sort of reading some of the literature, it's everything from names everyone will know, like Rio, to something like Infosys in India, which people will know, but it's different. So given the broad global remit, I mean, how are stocks selected?
Yeah, I mean, we're very, very thankful that we can invest anywhere in the world.
Yeah.
There's a lot of issues globally, so being able to move around them and diversify is something that we're happy to have. But that means covering the ground, and there's a lot to cover. So we start with our regional analysts.
Yeah.
At Aberdeen Investments, we have about 110 people based globally, covering the ground, visiting companies and producing research. So we start with them and use the research that they have. And that gives us, about 1,500 companies, give or take, that we have proprietary research on. The team at MYI International then come at that list from the global perspective, because we're not constrained by lines on a map. We can try and cherry pick the best ideas from that research list to help us deliver the investment objective. So, we kind of cover the ground by using the regional and global presence that a house like Aberdeen Investment has.
Okay, perfect. And when you're scouring the world, how much consideration do you actually give to the investment backdrop? I mean, it's been an interesting year this year. So in particular, what are your views on the sort of narrow stock market leadership, which we continue to see, and the moves away from globalization on the back of the US administration changes?
Yeah, it's another interesting year. I think every year it seems to be more and more interesting for different reasons.
Yeah.
I don't know what a normal year is anymore. But I mean, with regards to the investment backdrop, we are always, of course, giving careful consideration to that.
Yeah.
But more to do with how that's going to really impact the companies. I think we try as best as possible to accept that we cannot influence nor change the investment backdrop.
Yeah.
So take whatever that backdrop is, whether it's an inflationary cycle or a rate cycle or an economic slowdown or AI, but take it to the companies and the businesses and see if it alters your view on them. Look for risk and or opportunity in terms of your portfolio, but also the stocks that are available to you. So we do pay it mind, but it has to be put in its place in terms of what you can control.
Yeah.
And the only thing I can control is what goes into the portfolio and what doesn't. With regards to the narrow nature of the market, that is something that we are quite cognizant of, coupled with multiples, particularly in developed markets, coupled with the scale of passive investment and how much that is just market is continually being bid up. So it is something that we are mindful of. For a fund such as MYI International, a lot of the companies that are directly involved in that market concentration aren't really suitable investments given that investment objective. So I count myself lucky in a way that I'm mindful of it, but they're not suitable investments. So, we kind of leave them be and try not to distract ourselves by them.
Okay, interesting. And I feel the question is this your moment, right? So the current environment potentially bodes well for income stocks, which have been out of favour for a while in terms for global investors. Is this an interesting time for you?
Yeah, I mean, I think the last couple of years when, you have a little bit of volatility and or weakness creeping into the markets, whether that be the sell-off in the earlier part of this year and the subsequent recovery, investment companies that have reasonable, attractive, growing and sustainable dividends traditionally do hold up better in that environment.
Yeah.
I am a firm believer that companies that offer reasonable, attractive, growing and sustainable dividends over the long term is an attractive factor to be exposed to.
Yeah.
It can fall in and out of fashion, but that's okay. We understand that our shareholders are spread across numerous different funds and numerous different styles. And it's very, very important for us to, again, not necessarily get distracted by the environment, to stick to what your investment objective is, because that's ultimately what you've told shareholders you're going to do. So, I think given that the environment seems to be one of more noise and different rate environments, inflation environments, economic cycles, a little bit more of a kind of up and down movement to equity markets should be okay for a mandate like MYI International.
Okay, and let's get into actually, what the portfolio currently looks like. So maybe you can cover that off both by geographic exposure, but also the kind of sectors that you're exposing yourself to. Yeah,
so I mean, at the moment, we're pretty well spread across the globe from the geographic perspective, first of all.
Yeah.
So the trust's got about 33% in North America.
Yeah.
Which, if you compare that to most other global funds and certainly most global indices, is considerably underweight. Now, that's not that we're negative on the United States. That weight's as high as it's ever been.
Yeah.
But again, we're tasked with delivering 4.5%. If you start getting towards 60% in a market like the United States and the yield that offers, you might have trouble delivering that investment objective. So we've got about 33% in the United States, and then diversified better across the other regions that are available to us. 20% in Europe, 25% in Asia. We've got about 8% in Latin America. So we are really not afraid of making full use of that global remit. Likewise, at the industry level, really diverse across them. Financials is probably the largest weight at the sector level.
Yeah.
We have as much exposure to technology that we can have without hitting the revenue side and hitting that yield. Adequate exposure to areas like healthcare, consumer staples, right across the breadth of the sectors, to be perfectly honest. So the theme for us the last few years has been one of diversification across both geography and industry.
Okay, and I love to bring these things, so we've talked quite sort of in abstract terms, high level terms. I think it really brings it to life when we actually talk about individual stocks, right? So perhaps you could just run us through some of the investment decisions that you've made, either to get into or out of stocks for the portfolio.
Sure. I mean, what the most recent activity that we've been undertaking is to be reducing that technology exposure that we do have in the portfolio.
Yeah.
Where we tend to be exposed from the technology sort of point of view is within semiconductors, because it is that one area of tech where you can get yield.
Yeah.
Software is traditionally quite difficult for us. Now, obviously, companies like TSMC and Broadcom and BE Semiconductor and anything semi-related has been performing very, very strongly recently.
Yeah.
And we're a little bit concerned about where multiples have reached, and we're a little bit concerned about expectations going forward. So we've been reducing that exposure at the margin throughout the strength that we've been seeing.
Okay.
And where we've been putting that is more actually within some of the consumer discretionary names, where we are traditionally light. Again, discretionary is an area of the market that doesn't always offer levels of yield that work for us.
Yeah.
But we have been looking at names like Inditex in Spain, and have brought that into the portfolio. Lowe's in the United States, and we've brought that into the portfolio. So always recycling capital in terms of what's been performing well and looking for opportunities in terms of what's been weak on the other side of that.
Okay. And when you reflect back on the year, I think it's always a interesting exercise to think, what's worked and what hasn't. What's been the sort of biggest, largest positive contributor, and what's surprised you from a disappointment side?
So in terms of the positives, I think one of the standout stocks we've had, the last 5 years has been Broadcom. Now, we bought Broadcom. We wouldn't buy Broadcom today because it's yielding 0.7%.
Yeah.
That just wouldn't work for us.
Yeah.
We bought it when it was yielding 7% into the COVID sell-off, when AI was not even a thing. We bought, Broadcom because it was a semis business in the US. It was trying to diversify into infrastructure software. And we would have to concede that we've been sort of lucky with what subsequently came through in the recent years, and the performance that stock has enjoyed, because we did not go into it with AI in mind. It was additional semiconductor exposure. So that's been one that has been a very, very strong performer. But given the strength and given the yield, we've had to take that weight right down.
Okay.
In terms of the problem children within the portfolio, and that's the ones that you learn the most from, as you know.
Yeah.
I guess more recently, I would point to some of the Chinese exposure that we took in the portfolio, and in particular within some of the property names that we had, like China Vanke, China Resources Land.
Mm-hmm.
We went into them with the view of the positive fundamentals that we believed those companies exhibited.
Yeah.
But over time, those were just being focused on by the market less and less. And what became the overriding driver of that sector was, what are the government going to do?
Yeah.
And I have no more insight than that than anybody else. So unfortunately, we put ourselves perhaps in the position of macro government being the overriding driver of that share price, and the fundamentals become a really distant second in terms of what the market's looking at. So always been mindful of things such as thesis creep, and always reminding yourself why you went into a stock, and if that is no longer valid, then you should be coming out. And we have come out of both of those stocks. Okay,
it's been a fascinating run through. If there were any sort of key messages that you wanted to sort of leave with our audience, what would they be?
I just think it's a very tricky time. You can talk yourself into quite dark places when you focus on the uncertainty, political uncertainty, geopolitical uncertainty, market multiples, concentration. MYI International is a kind of counter to that. It is well diversified across the globe, and we are big believers in the power and the reinvestment of dividend income over the longer term, not exposed to any of those Mag 7 stocks, underexposed to areas like technology and the US in a relative context. So if you are looking for something a little bit different to what you're probably getting in terms of direct stock ownership, active allocations and passive allocations, then MYI International is possibly something that can help in that regard.
Thank you very much, Martin. It's been a pleasure having you on the next kickoff season for Vantage. Thank you for being on the show.
My pleasure. Thanks for having me.
Thank you for watching. And if there's anything that you want us to focus on, please do drop me a line. We will see you at the next one.